mind. Looks like we're in the click.
Welcome everybody back to our final episode in our mini dividend portfolio series. I got a cat actually crawling in the back. Do you see that?
I'm gonna look on my screen. Oh, I do see a cat there. Yeah,
I didn't even notice that.
maybe that's the Aristocrat.
Well, there you go. The aristocrat you're talking about in the last one. That's very fitting for today's episode because
very well scripted, Brandon.
Very well scripted. We've already covered three different topics in dividend, high yielding dividend stocks in episode 1. We covered dividend growth stocks in episode 2. We covered, what was our third one, Dad? It was monthly dividends. We covered a bunch of, and that was just last week. And we're finalizing our series here today with the final request, which is dividend aristocrats. And we're going to be going through 6 stocks, a selection from both of us, and really tie things together and take a look at how our hypothetical dividend portfolio. There's another cat jumping up on the thing too, actually.
Oh, geez. There's the aristocrats.
Yeah, true.
Yeah.
I'll show what's going on up here.
Oh, wow.
Yeah.
What do you leave up there? Kibbles and bits?
No, our dishwasher is actually blocked at the moment, Dad, which I may need to call in a father favor from you. I don't know how to unclog that. I tried, but anywho, let's get back into the video. Maybe I'll start off with this, Dad. For those viewers that don't know what a dividend aristocrat is, what is that? Can you explain a little bit just before we get into our stock picks?
I sure will. And there's sort of a basic definition, but there's a whole bunch of varieties of them as well. Essentially, what the aristocrats indices do is they acknowledge companies that have a long history of paying dividends, having uninterrupted dividends, raising dividends. There's different categories, and there's different rules for U.S. companies and for Canadian companies. And so I'm just going to go over those real quickly so that you know what we're talking about here. So I'm going to start first of all with the Canadian rules. They pale in comparison to the U.S., but essentially for Canadian rules, to be a member of the S&P Canadian Dividend Aristocrat Index, you have to have a market cap of at least $300 million. You have to have increased your dividend for each of the last 5 years. And then you must be also listed on the TSE and be a member of the S&P 500, the S&P Canada BMI, which is the broad market index. So
that's not a hard barrier to hit. 5 years.
No, there's a lot of companies that fall into that category. So it's a pretty low bar, in my opinion, to be called an aristocrat. Now, for US, it is a little bit more strict, and there are a number of different categories. I'll just go through those real quickly here. A dividend achiever is a company that has increased their dividend at least 10 years in a row. A dividend contender is a company that has raised their dividends for 10 to 24 consecutive years. A dividend champion is a company that has increased its dividend in at least 25 years in a row. Regardless of whether it's part of the S&P 500 or not. A dividend aristocrat, which we're focused on here today, is a company that is part of the S&P 500 for the U.S. companies and has increased its dividend for at least 25 years in a row.
Right.
And a dividend king is a company that has increased its dividend for at least 50 years in a row. So clearly the bar is much higher there, but we are going to be talking about some Canadian companies that have a long history as well that don't fall into this category directly, but we'll talk about that a little bit later in the video.
And I think, Dad, what this goes to show when you have companies that are paying these long streaks is that really gives us some insight into the company's management. We talk about that all the time, and they're ultimately the ones that dictate how much dividends get paid out to shareholders, how they're managing a company's cash flow. And, I think back to our dividend growth episode we did, right? Maybe we looked at some companies that were growing at 20%, 30% a year, and that's phenomenal. But just as important as that is how confident can we be in these companies to sustain those dividends during tough periods, right? It's great if a company's growing at 30% per year, but what if they've never been through a financial crisis? What if they've never been through an economic downturn? And yeah, the growth is great, but when you look at the aristocrats, which have been through these periods time and time again, that's really where I think the appeal is with these companies when it comes down to the security of these dividends.
To me, that really is the differentiator because it shows that, yes, management places a very high priority on the dividends. It also shows that, through rough waters and through calm waters,
Mhm.
they have the ability. Typically, you'll see on these dividend aristocrat companies, you're going to see a relatively conservative payout ratio. For example, you're going to see strong free cash flow,
Right.
because there's that margin of safety there. So when you do go through a rough patch, you're not going to have to either cut
Mhm.
or suspend, or in these cases, you actually have the capacity to increase. So clearly, if you've been increasing the dividend for 50 years in a row, there is a huge priority on that aspect, and you're managing your cash flow accordingly. Yeah.
Clearly. And there's one final note that I would say before we actually dive into the stock picks, and we'll actually notice this in one of my picks. There are times where companies will, if they don't want to lose this status of a dividend aristocrat or a dividend king, you will come across cases where a company will raise their dividend by, let's say, a penny, right?
Yeah.
During tough times, you may hear, oh my God, this company has an 80-year streak. That is phenomenal. But when you dig beneath the layers, well, in certain years, they announce that they're literally increasing their dividend by a penny. So by the book, yes, they have continued to increase, but it could be a little artificial. And that's just one thing to look at, right? We don't want to take everything at face value.
There's got to be there should be a little asterisk beside that.
Yeah.
Look at the year-over-year numbers to see a percentage. If it's 0.001% rise, does it really qualify?
Exactly. It's just something.
At least it means they didn't cut their dividend, I guess. So that's good.
Pardon?
At least it means they didn't cut their dividend. So
exactly. That's a positive there. And that's one thing to think about. But let's dive on into our stock selection. If you've made it this far, well, not this far, but if you've enjoyed this series thus far, leave a thumbs up on this video before we dive any deeper. That really does help out. Let us know in the comment section below. But Dad, take it away with your first stock pick.
Sounds good. As sort of as a usual practice, I'm going to split my picks between a Canadian company and a U.S. company. And my first pick today is from Canada, and it is the company Fortis. The ticker is FTS. I think you've covered this in its own solo video at some point in the past, Brandon. But Fortis is a company multiple times. Fortis is a company that is currently trading at around $55 or just shy of $56 per share, and is paying a dividend of 3.6%. Fortis is an amazing company in Canada. I'll just go quickly through a few of the things I like about the company. First of all, it has very diversified operations. That's one of the things I really look for is revenue streams. It's got 10 operations, transmission operations, electric and gas. They're into infrastructure. From an assets perspective, geographically, they have about 34% of their assets in Canada, 63% in the US, and 3% in the Caribbean. Geographically, you'll notice we'll just throw maybe a chart or a map up on the screen here, Brandon, and you'll see that they have operations in Canada, quite a few in the US, and then even in the Grand Caymans and the Turks and Caicos. And what I'm going to suggest, just to complete the due diligence on this project we've been doing, when we're allowed to travel again, I think we should go down to Turks and Caicos and the Grand Caymans for a couple of weeks, just to complete to round out the
check out how the utilities are there.
Well, we really should do that. So if you're up to that, I think we'll make arrangements for that once.
I wouldn't argue with that, Dad.
Sounds good. Carrying on with the company here, one of the things I like, and this is sort of a 2021 type thing, but they are moving towards a more environmentally friendly business. And you'll notice by a chart we have here, they're stating that by 2035, they will have basically removed all of the fossil fuel generation aspect from their business, which I think right now is still pretty reasonable, but I think they're going to get down to like 1% or somewhere in that range. So, virtually all of their money will be from, energy delivery, renewable, and carbon free generations. Quick chart here that shows the 20-year comparison versus the Toronto Stock Exchange, both the exchange itself and the utility sector. And you can see that the company has a very, very respectable return over that 20 time period. Now, I took this from their 2020 annual report. So, of course, there's charts and graphs can make anything look. They can pick periods of time, but I think this is a pretty good representation of how they've done versus the broader indices and their peers there. Talking now about their dividends specifically, because that's what this video is really about. They're paying about $2 a share in dividends. Again, I mentioned earlier that's a 3.6% yield. They've got a 5-year compound annual growth rate of that dividend of 8.7%, and they have been paying for 47 consecutive years.
Wow.
In fact, they've not been paying, they've been increasing their record. So I mentioned earlier, there's not many companies in Canada. In fact, there's no companies in Canada right now that qualify as the dividend king category.
Right.
But Fortis is on the verge.
Very close. Yeah.
Yeah, they can just hold on for a couple more years. In fact, I think maybe now, this was from 2020 fiscal year, and I think they may even be at 48 years now, but they may be splitting hairs. Canadian Utilities, I think, which you may be covering, I'm not sure if you are or not, that is the other major competitor. So they're the leaders in Canada. So for the purposes of what we're discussing here, for a company that is a true aristocrat, even by American standards here for Canadian companies, Fortis is a company that really rounds out a dividend portfolio, reasonable dividend, not high, not too low, but extremely reliable. And that's what we're looking for in this category.
I totally agree. And whenever we cover Fortis on the channel, this is one of the favorites in Canada. It really is. People, they know the business, they recognize it. It's just, every time I post a video on Fortis, the comment section get flooded with investors who are for this company. So good.
Ironically, because so many people probably pay every month their utility bill, and the money goes to Fortis.
Exactly. Well, let me move on to my pick, which is a U.S. selection. It's my only U.S. selection of the video. It's the company 3M. The ticker is MMM, triple M. And today the dividend is just shy of 3%, so a 2.9% yield. I'll pop up a picture on the screen for you guys. This company has paid dividends for more than 100 years interrupted, over 100 years. And they've also increased the annual dividend for 62 consecutive years. So this to me is a perfect example of a dividend king. Again, of course, we do have to look south of the border for that. But this is a stock that has quietly been up over actually 50% from the lows that the stock had seen over the past year or so. And it's funny, I remember covering 3M once or twice back on the channel when the stock was coming down, and there was not a lot of, as with most times when a stock is just in a downtrend and when it's kind of out of favor, there's not a lot of optimism for that. That said, again, to take a look at this chart, it was not dead. It's still here. It's still around. And this is actually one of the top dividend aristocrat plays, in my opinion. People tend to think of 3M, Dad, as I'm sure you know, during this pandemic, it really got kind of pinned as this pandemic play with the masks, the N95 masks. But when you look deeper into the company 3M, they are a much, much deeper company than that. And I can't even start to list the amount of products they have in their library, because we'd be here for a long time. But I'll have up on the screen just some of the different categories that they make products in. And I'm sure when you go to your hardware stores or anywhere, really, you're going to come across some 3M products. For some reason, I always think of them as like a tape company. I'm sure when people are taping things around the house, you always get the 3M tape. Again, that's just one of many products. But in general, this company does about $32 billion in gross sales, just to give you some perspective in size. In terms of the dividend, the company pays a dividend of $5.92 per year. So, of course, a US dollar dividend. And they managed to grow this despite this long, long streak. They're still growing it at a healthy clip. 7% for a streak this long is very, very impressive, to be honest. All doing so, as you said, with a low payout ratio. Clearly, if you've made it this far, you are not going beyond your means when it comes to the dividend. A 60% payout ratio is right in line with that. And what I'll be showing you guys on this screen is basically a few charts or clips that I took of the year-by-year dividends dating back to 1995. The chart goes back further, but I'm just going to 1995. And as you can see, year after year, these dividends are increasing. And I really think it's fun to visualize it in this way because you really get some perspective. And I talked about at the outset of this video, there are certain periods such as, the financial crisis back in 2008 and 2009, where you do notice the increases becoming smaller than usual. That's really to be expected as companies are, in some cases struggling to survive. But in general, 3M, I think, is a phenomenal choice when we're looking for reliable dividends. It gives you exposure to the US market and globally. They sell their products everywhere. But with the over 100-year streak history, 3M would be my first selection for the video.
I think it's a good company. And I was listening intently to what you're saying, and I will take a note later and look into the company a little bit deeper. if I'm not mistaken, 3M did invent the
Post-it notes. That's exactly right.
I believe.
I don't use post-it notes. That I use my MacBook for
Use
all
your
my notes.
phone.
That's kind of
I
old
know.
school.
Well, I reached into my drawer while you were talking, and I pulled this out because I am old enough to still use Post-it notes very rarely, but I'm trying to wean off of them. Yeah, I think it was an accidental. I think someone screwed up on the glue, and they just, if I'm not mistaken, the history of the Post-it note. But
You're probably correct. You're probably correct on that. Awesome.
But 100 years plus of paying dividends.
Crazy.
That's pretty stellar. So
stellar, yeah.
I'm going to move into my second company. It is a U.S. company as well, and it fails a little bit in comparison to 3M, but the company is Clorox, and this is a household name. The ticker on Clorox is CLX, trading at $190 US, so it's not out there for everybody. The yield is 2.3%, a little bit on the lower side compared to what we're talking with today. It's about $4.44 per share. Similar to the previous company I looked at, I love the diverse product line that Clorox has. They're 41% in health and wellness. They have a 27% product line in household goods, 17% lifestyle, and then about 15% in international sales. You will have Clorox products in your house. The sort of the poster child is the bleach, the Clorox bleach, but they have Hidden Valley Ranch. They've got the Glad saran wrap, that type of thing. Glad plastic wrap, I guess you'd call it. For barbecue coals, they've got Pine Sol. I mean, we'll throw a brand chart up on the screen here, but you can see how much of a household name you're going to get from this company. About 80% of their products are either first or second in market share around the world. So, that is really stellar. They have a very strong track record of delivering value. Here's a clip from their most recent annual report, and it shows their comparison to the S&P 500, the broader market. Stellar performance there, and they are growing their operating cash flow. I haven't been on this channel very long, but if you have been listening to my videos, I do place a high emphasis on cash flow. And if we look at the operating cash flow here, you will see a steady growth in that department, which really makes the dividends much more sustainable, much more predictable in that respect. On the dividends specifically, as I mentioned, they're paying $4.44 per share, about a 2.3% yield, not as high as some of the other videos or some of the other companies that we've covered in this series. But the whole point of this series was to give an array, a variety of different types of incomes. Some are higher yield, higher risk. Some are lower, more sustainable, just a whole variety. So when you're building that portfolio, you're going to spread those eggs through different baskets in that respect, right? They have about a 7.5% compound annual growth rate, and they have been paying the dividend for 43 years in a row. Very respectable, again, compared to 3M, not even half, but very reliable. And like you said earlier, in tough times, they've proven, because of the depth and the broad array of products that they have, that they do have staying power. So Clorox is a company that in a dividend-paying portfolio, I think deserves some attention.
Right. And I think that's a good pick right now too these days, like especially given the pandemic, because it's supposed to kill the virus, right?
Bleach is used. I'm assuming you're referring to the bleach, and bleach is used in restaurants and all kinds of cleaning things on a regular basis. So
I wasn't going for that. I was thinking when you drink the bleach, it'll actually kill the virus from the inside. But I'll just move on to my next.
Totally missed that one, but that was a good one. I wish I would have picked up on that quickly.
Okay, I'm going to move on to my next pick. I do really like that selection. That Clorox is not a stock that gets covered too much. But that's what a choice. I'm going to move on to a Canadian selection, and you did actually kind of mention it at the top of this video. You mentioned the stock Canadian Utilities. Now, if you recall from our previous videos, we actually covered Canadian Utilities in our first episode. I'm going to be going with actually the parent organization, which is the company ATCO, ticker ACO.X. Today, the dividend is very high at 4.22%. And for those that are not familiar with this company, on the screen, you'll be looking at a breakdown of the corporate structure. So as we can see, you'll note Canadian Utilities on the right side. That's obviously its own independent company, but ATCO is up at the top of this corporate chain, I guess we can call it. And this holding company actually does provide you some more diversification, a little more depth across different segments, because you are getting exposure to the logistics side of things, ports operations. We're actually going to take a look at those in a second. Construction, as mentioned before, and corporate financing, all those types of things that you're getting along with the exposure to Canadian utilities. When I mentioned that you are getting more depth, I'll put up a chart of the it's a map essentially sharing you what type of geographical exposure you're getting. And obviously through Canadian utilities, you're getting the Canadian exposure, as well as areas such as Mexico and Australia. The Caribbean as well, actually. That seems to be a place often where these utility companies do business, as you mentioned in your pick. But you do see through the ports segment of their business, you are getting exposure to South America. And that to me is quite unique. It gives you that extra layer versus just going out and buying utilities. Then you're getting the US exposure through their structures and logistics. And to the left of this chart, you will notice something that I do find is very important. They have a credit rating, a very reliable one, through both Standard & Poor's and DBRS, Morningstar. And I heard one thing the other day, Dad. It was when you are a utility company and people are relying on you for power and they're relying on you for electricity and water, this is probably the one area of all companies, maybe there's other ones that I'm not thinking of, but it's where the customers expect your product to be delivered day in and day out, 24 hours around the clock. You don't really get these pretty good, pretty reliable companies, or we're good most of the time. It's, we need to be there for you. We need to be a reliable company, and people really depend on that. And
I was going to say, like Rogers, for example, the other day when their system went down.
Oh, that was mayhem across the country.
Yeah.
That's a great comparable. That's another one nowadays that I would say is quite important. But with Canadian utilities, you see here, for example, 73 years of history in more than 100 countries. And you only get this far and advanced when you have when you run your business really well. So I think that's one thing that is worth noting, especially in an area that is relied upon as much as utilities. In terms of the dividend, 28 years of increasing dividends. So quite strong for the Canadian market. Again, in comparison, you can find longer streaks out there. They pay 44 cents per quarter, which is the equivalent of $1.79 Canadian per year. Overall, I would just say that this is a very, very safe play with the nice yield. So to start off today with a 4.22% yield, and a company that's increasing it, a company that's established across global exposure or global presence. I've covered ATCO before in the past, and I thought it was a good buy. It has picked up slightly. Still trading at a PE under 20. I think that this stock is actually not a bad one to be looking at the moment. That's just a personal opinion if you're looking for a buy and a long-term hold. But that is my second pick for the company. It's the company ATCO. That's
a great pick, Brandon. And it's not a household name necessarily, but as the parent company, the diversity beneath that title is quite immense. So
for sure.
Yeah. Well, I'll move on to my third and final pick for today. And I'm going to admit, little confession here, I'm going to cheat a little bit. This is a Dividend Aristocrats video. And so theoretically, we should be picking only Dividend Aristocrats. I'm going to pick an ETF. I'm going to share some information regarding an ETF that invests in a basket of Dividend Aristocrats. And the ETF is the BMO Equal Weight Bank Index ETF. So this is a Canadian ETF, and the ticker is ZEB, and it is a medium risk ETF that has only 6 holdings, and those are spread out between all Canadian banks. So there's 6 Canadian banks, all obviously around 16 or so percent. In fact, I think I can throw up a chart here that shows the distribution on those, or the balance on those. Yeah, around 16 or 17% per company. So they are rebalanced to keep those weightings equal. As a quick comparison, I just wanted to show a couple of graphs or a few charts on how this ETF has represented the Canadian banks. And it's because the banks themselves have different rates of returns over various periods, it won't replicate one of them. But if we look at the first chart here, this is just a 1-year number for these charts. So you'll see I put the 5 largest Canadian banks and ZEB, and you'll see on the right-hand scale where ZEB falls basically right in the middle on that 1-year time frame. If you look at a 5-year time frame, you're going to see ZEB once again falling right in the middle of the other banks. And lastly, you're going to see ZEB on a 10-year time frame, again, right in the middle. So this is a very good proxy, I would say, for the Canadian banks. The main reason I wanted to talk about this, without getting into the fund itself, is I wanted to give a shout out to our Canadian banks. And it blows me away how long, well, first of all, how old the banks are, even older than me, if you can believe that. Secondly, how long they've been paying a dividend. So just have a look at some of these numbers here. The longest paying dividend is the Bank of Montreal, and they've paid their first dividend in 1829.
Wow.
Yeah, I didn't even calculate how many years that is, but that's getting pretty close to 200 years, I guess, that they've been paying that dividend. Bank of Nova Scotia since 1832, TD 1857, CIBC since 1868, and the newcomer, Royal Bank of Canada, has been paying a dividend since 1870. So when you look at that longevity, they haven't been increasing consistently, but they've been paying for that period of time. And that just, that I thought that deserves some kudos to highlight the fact that our Canadian banks have been paying dividends for that long. The fund itself averages, I believe, around 3.5% yield, and it does pay monthly for those of you who like monthly. And it does have a management expense ratio of 60 basis points, so 0.6%. So that's something always to keep in mind. You could go out and buy those banks directly, avoid that management fee, depending on what your investment style is. So when I look at, again, the consistency, the reliability of dividend payers, and that's what you get with Aristocrats, this is another way of playing those without owning the companies directly.
Yeah, I wouldn't consider that cheating for this video. I think it's a very fair workaround because, especially this fund, it's a very concentrated fund on all Dividend Aristocrats. So although it's not an individual stock per se, I think that's a very, very fair pick personally.
I appreciate that, Brandon. Yeah.
Nice.
It wouldn't take me too long to go through all the banks one by one anyway. So
exactly. Okay. Well, I'm going to finish this off with another favorite here in Canada. It's the company Enbridge, ticker ENB.TO. The Canadian ticker trades for $46. You will note that this does trade on the US exchange as well. So if you are looking into this company, just make sure you're looking at the right one. Today, we're looking at a starting yield above 7%. And this, as we probably are all quite familiar with, this is one of Canada's top energy plays. They're headquartered in Alberta, and they're just a major transporter of energy. They do other things as well, but across North America, they're very involved with moving energy across the nation. The dividend itself, I'm just going to put up a beautiful chart here that shows the 10% compound annual growth rate. This chart in particular is looking at data back to 1995. They have actually paid cash dividends for over 66 years to their shareholders, not necessarily growing them, but still a very long track record. In this case, this is looking back in December. So about four months ago, they announced a 3% increase, nothing major, but still a bump up. This equates to about a $3.34 dividend per share on an annualized basis. One thing that I do get a ton of questions on when we cover companies like Enbridge, people that do take a little deeper dive will notice that the payout ratio is actually quite high. And that is absolutely the case with a company like this. And I know you mentioned that actually at the top of this video, as well as in your last video, we talked about just some workarounds and looking at dividends. And although net income is often kind of the standard, and that's what people do look for, you can also look to a company's cash flow and the free cash flow that they generate in order to meet these dividend requirements. And what you'll see is that over the past 3 years with this company, the cash flow has been trending in the right direction. And that may be simply due to the energy sector showing some more signs of life. It could be more of a play on global, the global economy just picking up and recovering. I know it wasn't long ago that Enbridge and Suncor and this entire industry was just on a steep downtrend, and everyone was saying at the time, Dad, everyone was saying here, oh, energy's dead. Energy's gone. It's like literally, I got those comments time and time again, and it's just so foolish. That's to me just a telltale sign that stock is a one to look at, because in Enbridge's case, it has picked up actually as of recently. Today, again, the shares that we'd be looking at are $46. Again, it still may be considered undervalued in the big scheme of things. If you do look at Morningstar, they do still have the stock rated as a 4-star buy even after looking at this nice little uptick that the company's seen, again, you're starting with a phenomenal yield. And what I want to kind of summarize this pick with, and maybe transition onto the end of our video here, Dad, is even in a very volatile industry, such as the energy industry, you mentioned that in the last video as well, where earnings do fluctuate a ton, the fact that this company has been paying dividends and in many cases increasing it, that's the perfect example of how management is able to manage these cash flows. There's actually a chart that I have here on the screen that just shows, basically going back a decade, that this company has sustained a nice high dividend with increases with time. And that to me just proves that, through the good, through the bad, through, macroeconomic events, through company specific events where the price of oil is changing in all different directions, these aristocrats, which have these track records, that does say something about the company. And I think that's, Enbridge is a very clear example to me because of how volatile it is. But that goes for all the companies that we covered in this video. When you get streaks like this, they don't just happen by fluke.
It's like you say, it's good, solid management through, in some cases, decades. And obviously not the same manager, but it's the corporate culture where they place emphasis on that. So great. That's a good pick, Brian.
Thank you. Yeah. Well, I really liked all the picks from today. This would be, looking at our 6 stocks for today, I think I like the companies. I think a lot of reliable options and a very healthy mix of Canadian and US.
I think it is as well. These are sort of representative of a number of other companies. If you, I don't know, Brennan, in the notes or the detail area below, if we can put maybe a link or two to some of the Dividend Aristocrat, lists.
True. Yeah, we can do that. Yeah. Put it in the description below. Yeah, I can do that.
And, important to note that we've picked 6 companies today and 24 overall during this series. And there are a lot of other really good companies out there. We'd love to cover them all, but this is where you can now take this framework that we've hopefully helped you lay down and go and look at what is best for you. But, at the end of the day, in fact, what I want to do before we close off today, Brandon, is go and look at that spreadsheet that we built up. We started 3 weeks ago, I guess now. And just a quick look at it on the left-hand side of the screen. I'll go through this quickly because if you've been watching the series, you probably have got this figured out by now. But you'll see the companies listed down the left-hand side, the current dividend yield, and the months in which they are paying the dividend. If you flick over to the right-hand side, you will see on the right-hand column the total that each of those companies is paying per year. And then just in graphical, just a quick point there at the top of the right-hand column, you're going to see a total of just over $1,000. So This would assume that you have a portfolio, $1,000 each, so $24,000 invested. I did the math earlier. I think it's around a 4.5% yield on average.
Portfolio. Cool.
Some higher, some lower, a real mixture of some higher risk, but higher payers, some lower payers, but much more secure. And that's really how you build a portfolio, is by having that mix. Finally, the chart at the top just shows in graphical format, this is how much payment you would expect every month. And if you're using that to reinvest, if you're using that to pay for groceries, or whatever your cash flow purposes are, this kind of gives you a good idea of, starting from scratch, how we've got to this point, and you can massage this for whatever works best for you.
Yeah, well, that's so cool to see everything come together like that. It was just piece by piece, and now you look at it and it is a fully functional, fully built up portfolio. And as you mentioned there, Dad, we're just cherry picking, 6 stocks out of each industry. These are just examples and ideas where you can branch off further into stocks that maybe resonate with you better, but it's the overall concept that we're going for. And there were other comments we got, we got requests to cover other topics, right? Like we picked our 4 topics here in the growers, the streaks, we covered all those. There were even more suggestions, and, we could have extended this series longer, I think we thought about, but at the same time, this was like a mini series. And I think we've kind of concluded that here's what a portfolio can look like. So maybe like if there are other topics that you guys would like covered on dividends, be sure to let us know down below, right?
Well, one of the ones we saw quite a bit were covered calls, split share corporations, which pay a much higher dividend. There's different mechanisms that they use to generate a higher yield than the actual underlying companies have. So I would expect that we will probably dedicate a separate video to that. But you're right. I think we were going to have 3 videos in this series. We extended it to 4. And I think we got to the point where, at least conceptually, we've laid down that framework. So you could go on, and you could add growth companies.
Exactly.
And, building a portfolio is much more than this. But this
exactly.
Start.
Agreed. So yeah, maybe those other video suggestions can be more tailored towards a specific video. So if you do have any other dividend related videos that you guys would like to see, leave them down below. We read them all, and those will definitely give us some inspiration for some dedicated videos rather than this series. Because I think now that we can just kind of close things off, conclude. And
before you conclude, I would like to say, we've been speaking specifically about dividends, but maybe there's another series with a different overriding topic,
right,
or category that you would like us to work on. And can't think of anything right now, but I'm sure there's something. So
sure.
Yeah, leave a suggestion that way too, and we'll make every effort to put that together. I've really enjoyed this sort of every Saturday, doing this, and let's continue in whatever direction that takes us.
I totally agree, and we'll let the viewers decide.
Yeah.
So leave your comments down below. If you guys enjoyed this series and you learned something new, as always, drop a big thumbs up, as that really does help out the channel. If you're not already subscribed to us, we post videos, our individual videos, joint videos. We do all sorts of stuff, multiple videos a week. So be sure to subscribe and hit the bell for notifications. And then, as always, we have our Investing Academy down below. You can learn all about that by clicking the first link down below. Anything else? Any final words, Dad? Or do we just close off the series and never open it up again?
Just close the series, never open it up again. No, it's been a blast doing this. I really hope we brought some value to you and given you some ideas and some concepts and some framework, like I said earlier. So no, let's just wrap it up, Brandon, and move on to the next series.
Awesome.
Okay.
Thank you guys so much for tuning in, sticking with us. If you watched I'm curious, if anyone watched every single one of these dividend series, let us know in the comment section below. I'm sure some people tuned in and out for certain topics, but if you've been with us through episodes 1 through 4, leave a comment down below, because that'll be awesome to hear.
If you're a dividend series aristocrat, we want to know about it. 4 consecutive weeks of watching us, that qualifies. Perfect. Well, thank you guys for watching, Dad. Enjoy your weekend over there. We'll see what we can do. I think the weather's supposed to be bad this weekend, but yeah. Yeah. It's supposed to be rainy all weekend, but oh well, that's life. That's life. Just go into the studio and make another video. Yeah, perfect. All right. Okay. Talk to you later, Dad. Okay. Bye-bye. Bye-bye.